Welcome to our first Mediobanca RegEvent. This is a new series of events dedicated to learning more about the innovation frontier across all sectors. We inaugurated with digital currency, a topic which has now become mainstream and on which there seems to be still a lot of confusion, mixing together cryptocurrencies, stablecoins, central bank digital currency, geopolitical implications, cross-border payments, and regulation. Today, we go to the origin and to the imminent future of this space. Diem, formerly known as Libra, is the subject of today's session. In 2019, the Libra white paper broke out like a shooting star in the night, flabbergasting the system and giving everyone a wake-up call. Since then, we've seen massive R&D in the field, adopting new technology to improve services for clients. It has certainly been an intense learning curve for all, private players, central banks, companies, investors and users alike. A lot has changed and keeps changing by the day. All central banks are currently engaged in developing their central bank digital currency, with the ECB due to make a decision on the digital euro next week. The Fed will publish its findings on its study on CBDC this summer. New regulatory frameworks are being redacted to embed this innovation. Today we have the pleasure to host Christian Catellini. He is co-creator of Diem and chief economist of Diem's Association. He's also a reference in the digital currency world and in research on blockchain. First, he will update us on Diem's projects with a few slides. I will then ask him some questions, and then we will open the Q&A for a total of around 50 minutes. You can already start submitting questions now. Christian, thank you so much for being with us today. The floor is yours.
Andrea and everyone else, it's a pleasure to be here, and I look forward to giving you an update on our thinking around Diem, but also on the broader space and some of the changes that we witnessed over our journey and regulatory engagement. If we can get the slides on screen. Perfect. As you all know, this is a space that has gone through major waves of change and innovation. When I co-designed the MIT digital currency experiment between 2013 and 2014, interest in cryptocurrency and blockchain was much lower than it is today. And there's been waves of speculations, waves of new types of products and services being introduced, from DeFi to NFTs. And I want to put this a little bit into perspective. Another really interesting trend, and Andrea was already referencing this, is that the first version of the Libra white paper, as it was called at the time, was sort of also the trigger for a lot of activity on the public sector side. And we see this as a very positive development because, to some extent, I'll argue that you need both public sector and private sector innovation to really make a dent on some of the challenges that we face today in payments and in financial services in general. At a high level, from an economics perspective, this is a really interesting technology because it fundamentally changes two costs in society. The first is cost of verifying digital information, so verifying state. This is one that gets talked a lot. But the more important one is what we call the cost of networking, which is essentially the ability to bootstrap new types of digital marketplaces, new types of digital ecosystems, without assigning control to a single intermediary, typically the platform architect that is managing a platform. And another way to think about this is that blockchain technology, DLT, and cryptocurrencies are really lowering the cost of delivering interoperability into the system. Now, interoperability is extremely important. If you look at this picture from the early days of the internet, it's because of interoperability that we saw a whole wave of innovation and commercial services on top of the internet. Beyond interoperability, blockchain also enables programmability. And as you think about conditional payments, escrow, and all sort of interesting financial applications, programmable money is one that we can build on for decades in terms of new products and services beyond what we have today. Now, what's interesting is that this whole process of interoperability and programmability changing industry structure is kind of playing out across a number of fields. You have DeFi or decentralized finance, which is essentially making more modular some of the building blocks of the financial system and financial products. You also see this in content creation with non-fungible tokens, from the arts to media to journalism. There's a number of industry verticals that will be reshaped when you bring this technology and enable new types of products and services on top of it. Now, what's interesting is that often you hear the narrative that the technology is all about removing intermediaries from the picture. But I think that that's a very narrow view of the challenges here. Society really relies on intermediaries to convey values and principles into all these systems. And so if you think about a new generation of fintech being built on things like decentralized finance, the question becomes, in a world without intermediaries, how can regulators really create safe and sound marketplaces and ensure that these ecosystems and protocols serve society's overall needs? How do you prevent, market manipulation? How do you prevent bad actors from exploiting the system, for example, to do money laundering or other types of financial crime? And you often hear that, this is just another instance of software eating the word, to quote Mark Andreessen's famous quote about kind of what the internet has been doing to different verticals of society. But I think what's interesting here is because it relates to money, it relates to payments, it relates to financial services, there's actually a much deeper interplay between code and software and protocols and the institutions around it. And so for the technology to really reach its full potential, I will argue that institutions, both on the public sector and on the private sector side, have to evolve to ensure that we can actually harness the potential of the technology for the benefit of society. At a very high level, why are economists like me excited about the technology? There's some very clear long-term benefits. This is a really good technology for bringing more competition in financial services and payments, more innovation, and eventually delivering more choice to consumers and businesses. Part of that happens through interoperability. Imagine a consumer on a new wallet being able to pay anyone that is maybe on a larger wallet that has a much larger installed user base. This doesn't happen today in payments. Payments are very fragmented, and you kind of see a lot of wallet gardens that really limit the potential for interoperable, low cost, low friction payments. It also lowers barriers to entry for new types of players, whether these are startups or tech players or others that want to provide new types of products and services in payments and financial sectors. It's also a great technology for delivering better privacy. And of course, there's an interesting interplay between privacy and ensuring that also this complies with AML and CFT regulations. Often people will talk about increased transparency. That's an additional value add. But again, for all of these benefits to materialize, I think public sector institutions will have to develop new legal frameworks that enable the technology to kind of fit into some of the traditional rails. And there's a lot of talks about stablecoins. Stablecoins were kind of originated as a way for crypto traders to come in and out of crypto on exchanges that didn't have really good on and off ramps, but they've developed into something much larger. There's been an explosion in the market cap of some of these stablecoins, and now the total issuance of some of the leading ones is over $100 billion. Most of them pegged to the dollar, but of course there's also experiments with pegging to other types of assets. But one of the challenges is that, although these are called stablecoins, today they're anything but. And the risk is really that when you look at one key relationship, which is the relationship between the underlying asset that you're trying to peg to and the asset backing the stablecoin, there's a whole array of solutions that you're seeing in this space. From left to right, you have stablecoins that are issued and trying to peg against the dollar, but are actually collateralizing it or even under collateralizing, so they're not even one-to-one, with assets that have no correlation with the dollar. This is extremely risky, and I'll talk a little bit more about it in the next slide. But as you move through this spectrum, of course, if you think of it almost as a currency board, the closer you can get to the real asset. So a central bank digital currency essentially would be perfectly correlated with the underlying asset, because the central bank would be issuing both the digital token and, of course, the underlying representation. You do have a number of solutions. And where Diem has really innovated and is trying to get as close as possible to the CBDC design and actually take it to the next step so that the system is easily upgradable towards a CBDC, such as the digital euro. Now, what's interesting is, and I don't have a lot of time to go into the details, is that On top of this key dimension of volatility against the reference asset, some of the stablecoins out there are actually subject to the risk of a debt spiral. We've seen this with unsound currency boards in the past, so it's not a new problem. But if you have a stablecoin that's under collateralized or it's collateralized with something like crypto, which could change in value dramatically, or even worse, it's collateralized with its own equity token, that stablecoin could go to zero. We've seen this with very small examples, but eventually this could also happen at scale, and something that regulators need to worry about, which is, some of these assets that are meant to be stable could, completely collapse and leave consumers or their users with little to no value. Now, why build a stablecoin? You should think of it as a digital retrofitting exercise. So essentially really using faster digital rails on top and integrating them with the legacy system. The idea for Diem, at least, is really to reduce cost, delays, and fragmentation in payments. Payments today are highly inefficient in many regions of the globe. They're extremely costly when it comes to cross-border. Average cost, 7%, according to World Bank data. And even smart remittance senders pay on average 4.2%. On top of that, if you can also change market structure and improve payments, you can add programmability. And so over time, you can develop new types of products and services that both consumers and merchants and businesses would like. Now, the reason for working on a new type of stablecoin is that we do not believe that current solutions really offer high standards when it comes to consumer protection, the reserve design. Again, think about the volatility against the reference asset, transparency, and really knowing what is backing each one of these coins, and also a plan for not interfering with macroeconomic policy and financial stability, for example, in emerging markets. The other critical dimensions, of course, is financial crime and compliance standards. Stablecoins today allow for unhosted wallets. That is a very good way to lower cost of accessing such systems, but that lowers costs both for good and bad actors. And so you have an unsolved problems on existing stablecoins of how do you separate, good actors from bad ones and really protect the integrity of the system. Now, one of the challenges for Diem is, of course, Diem is designed to kind of meet very traditional frameworks. Think about the Basel III framework that you're all familiar from with banking when it comes to the reserve design, or some of the compliance standards that are used within banks and other payment systems. But these are choices that really impose higher demands on VASP, so wallets, exchanges, virtual asset service providers coming onto the system. And in a sense, Diem will have to compete with other stablecoins that are able to not add any of these additional features, and so have much lower friction for growth and adoption. But taking a step back, another area where Diem is really unique is that we're the only stablecoin to date that has publicly committed to really phasing out our own coin when a CBDC becomes available in any region where Diem operates and kind of as a Diem coin. This is a really important commitment because when you think about that spectrum of volatility against the reference asset, CBDC will always be the gold standard. And given the current framework, we can get as close as possible. Our reserve, for example, for the Diem dollar is planned to use only 92 days or less US Treasuries. These are HQLAs, so high quality liquid assets. They're extremely available. They tend to perform well in stress times. And on top of that, there will be capital requirements and buffers really in accordance with banking standards. We think that's as good as it can get today. But of course, if you have a CBDC, you can do better. And so this is a project that is actually committed in working closely with the public sector. Again, this was our journey over the last 3 years of gathering feedback from regulators and really trying to understand what would it take to take this new technology of digital assets and develop something that the regulator group and also merchants and businesses could be really comfortable using on a day-to-day basis. Now, there's a lot of talk about public-private partnerships in the development of CBDCs, and I would say like one of the best quotes I've seen is really this one from the Bank of England that really stresses the point that a CBDC with no private sector involvement might be resilient, fast, and reliable, but will not deliver on competition, innovation, and really the relative comparative strengths of public sector and private sector. So to summarize, why would you want a public-private partnership in this field? I think the public sector can bring a lot into the picture. And I think this is particularly important today where you have projects such as Diem that are trying to engage with regulators and really bring on all the protections you want in the system, but you also have completely permissionless alternatives that don't play by those rules. And those are growing, and they provide a viable alternative. So I think public sector activity in this area is important to ensure that some of the things that we come to expect from central banks can really drive into the future. Public sector can deliver on stability. Of course, it can deliver a coin that preserves value and really is high resilience from cyber attacks and all sort of other challenges. There's all sort of questions around privacy and anonymity of cash. That's, again, an area where the public sector is going to have a comparative advantage. More importantly, I would say the public sector can really ensure that anyone participating on these systems has to meet certain standards of consumer protection, financial stability, market integrity, and of course, not interference with macroeconomic stability in regions where access to our currency could present major challenges for the local banking system and the local financial systems. The other area where the public sector can really drive competition is by ensuring interoperability across networks. And so you can imagine a future where actually the public sector interfaces with many different types of networks and people compete on those networks for consumers and business share. There's also a broader global harmonization challenge for this technology to be really helpful for, say, remittances and cross-border payments. We do need legal frameworks to converge. The Financial Stability Board has been running a group on stablecoins on this issue, but more is really needed to ensure that that coin can transfer and people can use it, for example, when it's received as a remittance. Now, why would you want private sector involvement? Well, most of money and payments today is a public-private collaboration. Typically happens with banks, and in fact, we see banks as a key element in this ecosystem. But the private sector clearly has an advantage in developing those consumer and business experiences. It's going to move faster. It's going to be able to experiment with programmability in a way that's going to be very difficult for a central bank to do, and can really accelerate time to market. And I do think there's time pressure here because other countries are accelerating their own projects, and it's important for Europe, the United States, and many other regions to have alternatives that are available to their citizens. So I will conclude again with a picture of the early internet. And I think very much like in those early days, the regions that will thrive in digital currencies, crypto, and this broader new space of digital assets will be the ones that would get this public-private collaboration right. The United States got that balance right with the early days of the internet. Again, this is why I put this picture up. But I think there's an opportunity here for regions, including Europe, to get that balance right this time. And to have some of the leading innovators really build on public sector rails and also the private ones. Thank you very much. I look forward to discussing this with all of you.
Christian, for your presentation, which at least to me represents another step in the development of the project from its origins. I will go quickly as I have many questions and there are many more coming from the web. I'll start an easy question first, which is essentially, what products and markets are you really targeting and when are you launching?
Yeah, so on the sequencing, the sequencing is very much driven by where is the opportunity. And the opportunity is in markets that currently, experience very high friction. So starting with cross-border and remittances, I was already mentioning the very high cost that most people experience when they try to, send money to their family and friends. So that's an area where a network like Diem in selected corridors could add tremendous value by really, allowing consumers to move money instantaneously, almost for free, maybe paying conversion rates to their local fiat that are much more like the wholesale rates rather than the ones that they get charged through traditional legacy systems. So the P2P cross-border use case is a really strong one that we think, has a lot of room for competition and innovation. Now, the next natural step is in regions where you do have, say, the local currency, whether it's the DM dollar, you can also innovate in merchant payments. Merchants pay very high fees, especially small and medium merchants, for accepting payments today, especially digital payments. And that is a tax on the system. That's a tax on the merchants. And of course, that reflects in higher consumer prices. So we think, the natural sequence after some of these cross-border use cases is really enabling more competitive payment acceptance modes for merchants. I think we've seen similar progress in regions such as India, where once you have something like UPI, you do have shared infrastructure the cost for merchants and businesses come down dramatically, and of course also for consumers. So, that's kind of the natural sequencing, which is really following where the costs are currently very high. And in terms of launch, we're the only project that is heavily engaged with regulators. As I've mentioned before, our first white paper was extremely naive, had a number of gaps. But over the last, over 2 years, we've engaged with a number of central banks and other regulators. And as part of that, we've really evolved the design. So when it comes to launching, that is very much a dialogue with the key regulators around this.
Thank you. And a question on repositioning at this point, because you mentioned it in your presentation and just in the answer you've given us. It looks to me like Diem has made a spectacular repositioning versus its original version in a very short space of time. Can you explain us what you have done, what has changed, and why?
Yeah, so I would say that the project that you see today is completely different than the one that we started with. And to some extent, I think when we wrote the first white paper, we knew that this set of ideas would need a lot of work to be completely fleshed out. There's a number of dimensions that we're lacking in the first white paper. Think about AML, CFT, compliance in general, and what is the framework for using digital assets, but in a way that is comfortable to what the payments and financial system has been developing over decades. So I would say the first big area is participants on our network cannot be unhosted wallets. They have to be VASP, regulated VASP. And so these entities will have to go through an onboarding process that's very similar to the onboarding process that a bank would do for a new customer. In fact, the chief compliance officer of Diem used to do this for a major bank. That first screening is very important. But on top of that, Diem will also do monitoring and will run a financial intelligence function that network-wide will try to really understand signals to ensure that the system is operating as expected. So I would say the first big area is the compliance one, where now the system looks a lot more like traditional payment systems. The second major area, and this is one that, of course, I worked intensely on, is our regional basket currency was really targeted at cross-border. People got extremely worried at something that looked like the SDR because they thought it could be a threat to unit of account, which wasn't really the purpose. The purpose was to facilitate cheap, effective remittances with something that's low volatility against your local currency. Nevertheless, we took a major step back and we realized that why don't we just enable single currency stablecoins? We're going to start with the dollar. That's kind of the starting point, but the hope is really to add more of these. And eventually over time, as I was already mentioning, phasing these out and integrating directly with public sector rails and CBDCs. We do see a future where CBDCs are somewhat inevitable. They may take many different shapes and forms, and we want to ensure that Diem is, compatible with all of these. And so even our business model has been adapted to really not rely on things like interest on the reserve in the long run. All stablecoins today really draw a lot of revenues from interest on the reserve. But of course, if you want to support like a Diem Euro, interest rates are going to be negative. And so you have all sort of different challenges in supporting currencies with negative interest rates. To summarize, I would say that the compliance framework, the reserve design, and the promise to really collaborate with central banks and essentially fade out these tokens when it's time and when the public sector is ready, those are the major changes of our journey so far. We've also moved away from a technical aspect. We had this idea of transitioning the network to permissionless. It was really inspired by the concept of driving competition and innovation in validator services. But we do realize that regulators were really concerned about, what does governance look like in a permissionless network? How do you ensure that, some bad actor does not accumulate, say, the equivalent of mining capacity? Again, Diem is environmentally friendly, does not use proof of work. But you could still imagine a model where if you were to go permissionless in the future, you don't have the same governance guarantees that we have in our system.
Yeah. So actually focusing on just one of those aspects, which is privacy. Data privacy and usage for commercial purposes have been one of the main public concerns with digital currency surveys that have been run. Can you explain how the system will interact with the members of the association and where will the data be stored?
Yeah, so first of all, you don't need to be a member to operate on the network. So if you have a wallet service, you're a payment service provider, you're a card network, or you're an exchange, As long as you pass the compliance requirements and go through all those checks, you can operate on the network. But to your point about privacy, I think it's important to realize that one of the things we kind of learned through the journey is that from a privacy perspective, it's really important for Diem to not have PII. And it's really important for Diem to not be involved in that consumer relationship. In a sense, what Diem is doing is replicating the current model where consumers trust their service provider, and that's the entity that's going to see their KYC, is going to see their document, is going to have that information. And so the hope is that we'll really be able to drive competition between all of these service providers across a number of dimensions. Could be price, could be privacy, could be all sort of features and aspects of the project. So, really to summarize, Diem as privacy by design, and the network will not collect private information. Consumers will have choice. And so ideally, when they choose a wallet, when they choose an exchange, or let's say they want to operate on Diem using their bank, they'll be able to kind of retain all the privacy that they enjoy today with the service providers.
Thanks. So I was very caught by your latest CBDC remarks. You said that you would be happy to give up the stablecoin with the advent of CBDCs. What do you mean by that? And could you become the enabler for a faster time to market of CBDCs? Could you convince central banks that by adopting the Diem platform, they would stay in control of unwanted creation of money, that they would hold the data, and that they would conserve the direct claim by users and central banks?
Yes, and this, the short answer is yes and yes, but to give you a bit more detail on that, I think actually there was a great speech by Vice Chair Randy Quarles from the Federal Reserve Board just a few days ago. And in his speech, he was surfacing the fact that you could imagine the right regulatory framework, the right protections, combined with private sector experimentation, really delivering on innovation in a way that makes maybe the race to a CBDC less urgent, or at least something that central bank could take more time studying and developing. At Diem, we believe that again, I showed you the chart about volatility against the reference asset. The CBDC will always be the gold standard when it comes to a coin. A digital coin in the future should be issued by a central bank. Now, that coin should be usable and available on a number of networks. This could be the legacy credit card networks, could be legacy payment systems run by banks, could be new types of networks such as stablecoins. And I think consumers and businesses will win if those CBDC coins are available on as many networks as possible. Those networks are interoperable so that you drive true competition and nobody can create kind of a walled garden around their network. And you also ensure that it is private sector experimentation that explores how should we make those coins useful to consumers and merchants. That's an area where I don't see the central bank having an advantage. Just imagine how complex it would be for a central bank to interface with every retail customer. Or what would happen in a crisis if consumers could just move their assets from their bank checking or saving account to the CBDC token. That clearly could create all sort of instability. And so I think what's interesting is that this is a technology that allows for the unbundling of the tech stack around payments. Payments today often are a blend of credit and payment functionality. You don't need to have all those services combined, and you can offer more choice and lower cost to both consumers and businesses by potentially having public sector experimentation with CBDC. So think of that as the bottom of the stack, the high resilience network that all of these participants would use, and then a number of networks competing for what might be the applications of the future. There could be all sort of use cases in digital payments that will need public sector support on the coin, but actually private sector effort in really developing use cases and experiences that are actually useful.
That's clear. Another question on what you just mentioned before, in the conundrum the central banks are having to face between speed of development and control of their own systems. What is your perception of the central bank's priorities between having an operating CBDC quickly to compete with China and developing their platform from scratch? And what is Diem's role in this dynamic to you?
Yeah, so of course you have countries such as China that are really racing ahead. I mean, it's impressive what DCEP looks like already in terms of experiments, early adoption, and really functionality. I think it's really amazing that a central bank can push something so quickly into the hands of consumers and also drive adoption at the same time. That does not leave a lot of time for alternatives. And so I think it's really important for Europe and the United States, the UK, and many other regions to think seriously about, in a world where you do have these digital asset networks that are new types of financial and payment networks, what role do you want to play in it? Now, I go back to that picture of the early internet. I think that one is an extremely important one, because if you roll back the clock to the early days of the internet, the countries that did extremely well were countries that really realized that public and private had different comparative advantages. Now, you could, start a very thoughtful process with experts and policymakers and regulators and design the perfect CBDC. My sense is that that process would be riddled with delays, and by the time it hits the market, it probably would not have a lot of product market fit. And so you could imagine a different approach, and this is where kind of Diem wants to offer one of the potential solutions, where there is a private-public collaboration, very much like with banks today. Money creation is, of course, a collaboration between the public sector and the private one. When it comes to payment networks, I think you could imagine something very similar. And financial institutions, traditional banks, I think, can play a major role on networks such as Diem, because they can suddenly see it as a way to deliver cheaper payments, new types of functionality to their customers, while they're still focused on their core business. So, I think it's important for Western central banks to think really seriously about what the response should be and what the timeline around that is, and really, diversify their bets. I think one of the major risks is that, if it takes 5 years or more to develop a CBDC, again, by the time it's available to consumers, and when I think we've seen a similar set of challenges with the upgrade of traditional RTGS systems in payments, worked really well in some countries, not so much in others. If we care about interoperability, if we care about competition in payments, then again, stablecoins, I think, have a lot to add if they're designed right. And this is where, again, the public sector can do a lot to ensure that there are quality standards, there are consumer protection standards, and these instruments don't become a threat to financial stability. Lael Brainerd, governor at the FRB, compared this to the period of wildcat banking, where you had all these private currencies issued by private institutions. And we know how that played out. I think if stablecoins do not meet better quality standards, that is a very serious concern. And that's something that, we've learned through the interaction with regulators, and that's something that we would love to be able to fix.
Okay, and I'll just restrict my questions to one more, because we have a lot of questions that are coming in from people who are attending the call. But the very final one to me has to be on cross-border. You mentioned about remittances. There's a lot more about cross-border than that. There's the risk to destabilize emerging markets by giving people access to stronger and more stable currencies and so on. So what would it take for Diem to give access to the US dollar stablecoin across borders? What are the limitations? How are you thinking of making it kind of acceptable for central banks and kind of avoid having another stop and go on this?
Yeah, so first of all, again, there's an important feature of the Diem system, which is to operate in a region. You need to be a regulated VASP, so virtual asset service provider, that can enable the services in that region. So by design, to enable any remittance corridor, we would need at least two entities or the same entity to be regulated on both ends. Once you have that, of course, if you're regulated, say, in an emerging economy where you're worried about flight to our currency or currency substitution, that entity would probably have to follow whatever the requirements are locally, whether there's a maximum balance that you can hold of DM dollars before you convert, or any other sort of rules around foreign exchange controls. We think that is actually the right approach, for the simple reason that we would love for remittance flows to be enabled on the way in, even if they have to be converted into local currency. That's what we think is a sustainable model. And it's a much better option than, for example, other stablecoins that are actually actively supporting dollarization. we see that as a challenge and one that eventually will close these networks from wide adoption in some of these regions that really needed the most for the inflows coming from remittances. So at a very high level, again, you'll need regulated entities on both ends, which of course is going to be additional friction. This is where I was saying that DM will have a slower path to growth and adoption because it will need to be regulated in all the regions. The entity present in the region will need to be regulated and allowed to operate there. But more broadly, over time, hopefully we can enable more currencies. That's when the network becomes extremely useful, where you're receiving your remittance in your local currency, and then you can actually spend it on goods and services without having to do one more conversion into fiat. That's when you can lower cost even further. But of course, it's going to take a lot of time because in some of these regions, a CBDC may not be around for the foreseeable future, and DM may not be able to support a DM coin anytime soon. But that's essentially how we're thinking about cross-border and really ensuring that we can lower the cost of global remittances over the next few years.
Okay, fantastic. I think we have freed up a few more minutes that we can actually save for Q&A, if you agree. I would just encourage everyone to keep sending questions. We have already selected a few. I'll start with the one from Francisco. He is asking if CBDCs arrive and use DLT or blockchain, does DM still make sense? And are there still benefits compared to a CBDC based on DLT or blockchain?
I think, look, DM will have to interface with all sort of different technological stacks. Some countries may decide to just upgrade their RTGS systems. Others may choose a blockchain. When it comes to a central bank, you have a central actor. So the benefits of distributed networking and blockchain may not be as salient. And I think the public sector should really land on whatever technology makes the most sense and is the most resilient for them. Hopefully, what is left there is some interface with different types of networks, right? So you would want that public sector CBDC to be able to operate with different systems, whether they're blockchain-based or not. If you have that, then it doesn't really matter what technology the public sector chooses. And in fact, you could almost argue that more long-standing technology that's already integrated with some of the legacy systems may be better for some central banks versus others. So that's how we're thinking about that interface. And again, if it's developed on a blockchain, there may be some interesting things you can do between two different chains. But if it's not, I think there's other technological solutions for making all these systems compatible, which again should be the goal here, to drive interoperability, because interoperability drives competition. When two systems are interoperable, you tend to really see them fighting for consumer share and for merchant share much more aggressively than when they're not.
Okay, thank you. I'll move to Robin's question. He's asking, payment providers tend to sell their services directly to the merchant. How will your offering be incorporated or distributed? Over the world at the moment, there are several hundreds different payment methodologies. How would this be integrated?
Yeah, so as you can imagine, you have the legacy card networks, you have payment service providers that are quite active in the digital space. And we're welcoming all of these different players on the network. They can come on and they can find cheaper, more efficient rails that they can use for their products and services. But DM will need collaboration with payment service providers to bring merchants on board. Those are the entities that will be able, for example, to accept the DM payment, but also pass fiat to the merchant. Merchants will not want to hold DM coins anytime soon. And so we think it's really important that we work with PSPs and we really enable new types of products and services through them. That is, again, not unlike what happened, for example, with UPI in India, where PSPs, of course, had to revise their costs down because UPI is a much more competitive network. But at the end, can still add a lot of value with our merchants interface when they want to accept digital payments.
Thank you. I now move to Silvia's questions. She's asking, would DM become an open ecosystem, Ethereum-like, and where payment service providers may build up VAS, or rather it would be a closed circuit?
Yeah, so this is one of the design choices that in dialogue with regulators, we changed relative to the first white paper. In the first white paper, we envisioned some progression towards a permissionless system. Now, the reason why we did not have a roadmap for that was also that there is no permissionless systems to date that meets a number of economic requirements. And in fact, we did some market design work on kind of the equilibrium state of most proof of work or proof of stake systems. And they do have all sort of side effects in terms of market concentration. But even if you put that aside, the main reason for not transitioning to permissionless is that, again, there's concern around the governance of the network. And how can you prevent bad actors from kind of participating in that governance? So the solution we landed on is one where Diem is a permission network. It's based on BFT, so Byzantine fault tolerance. Those are the same systems that you use when you're on a plane, an Airbus or a Boeing, right? To get the avionics to talk to each other, that's BFT technology. So it's been around for decades. On top of that, you can use market design to really ensure that you have vibrant competition for validator services. So that's something that we plan to focus on later on, which is, although we have a permission network, how do we ensure that compliant players can come in and compete on a leveling playing field? So we think that's a really important property, and almost like a hybrid where you bring the good economic properties of permissionless networks on a compliant framework.
Wonderful. The questions keep coming, so I keep them turning out. Elise is asking, you mentioned potential future collaboration with central banks. How would you fight against the inevitable public distrust of the private sector involvement in such a critical matter as money?
I think, again, hopefully it's not just Diem, and there's going to be other networks and alternatives. I'm not advocating for the public sector kind of choosing one network and working only with that network. I'm advocating for the public sector creating the right framework for different private networks to come in and compete on a leveling playing field with high consumer protection, financial crime, and compliance standards. Look, on the mistrust, Diem is an independent organization. It has a number of members, all with one voting right. But over time, trust is earned as you go live, as people can really see your actions and decisions. If anything, I think we started with a white paper that created a lot of mistrust. I think our choices speak to an organization that was able to absorb the feedback and really iterate on that. I don't think we're getting credit yet for how much we've evolved the design to really meet regulatory demands. But hopefully, over time, the substance will prevail over the noise.
Anna is asking, how will be set the amount of DM issued? Will there be a limit for each consumer?
Yeah, so there's all sort of considerations that go in potential limits. DM is going to be the first network, for example, to support travel rule by design. And in fact, to move value above the travel rule threshold, you will need the VASP, so the participants, to co-sign that they've exchanged beneficiary information. Similarly, the network also has protocol level support for sanction enforcement, so that sanction address would not be able to transact on the network, irregardless of what the participants may want to try to do. I think at a high level, we're taking a phased approach to launch, and so you could imagine having limits, self-imposed limits, or limits that we would discuss with regulators, both around the maximum reserve size, maximum balance per users, and all sort of other dimensions that we think are important for testing the systems and bringing it to scale in a safe and compliant manner.
Okay, Tilo writes, a major advantage of stablecoins like USDC is that they are cash-like, open to use for everyone. You mentioned wallets need to be KYC cleared. How easy is it for third parties to integrate with DM and build on top of it? Who controls access?
Yeah, so the integration requirements will be very transparent and available to anyone. The simple answer is that the compliance bar will be higher than existing networks. And the challenge is that existing networks essentially allow anyone to interface with them, right? You can create an unhosted wallet on all of the leading stablecoins, and nobody will ever know. Are you kind of a good actor? Are you a terrorist organization? Are you, a cartel trying to launder money? There's all sort of challenges with the current setup around stablecoins. With DM, you have to first onboard with a regulated entity. And so DM will onboard these entities and do kind of the compliance review that you would imagine a bank would do when onboarding a new business. And these entities will be regulated. So in the United States, there could be money services business or other entities that have licenses for kind of moving value in a digital asset such as DM. That brings a lot more safety, but of course it's a higher integration bar and it's higher friction. We think it's important to deliver a safe environment. But of course, you could imagine other ecosystems that don't have any of those protections developing much faster than DM itself.
That's clear too. From Andrea or Andrea, depending on where it's coming from, is DM compliant with FATF, the Financial Action Task Force travel rule, according to which recommendation 16, in terms of disclosure of senders and receivers' names in every fund transfer?
Yes, the short answer is, those are the kind of frameworks that our compliance team has been working through, and then our engineers are translated into code. So you can go to the DM website and look at the DIPs, as we call them, so the DM improvement proposals, and there's a number of them that really touch on compliance issues related to travel rule and beyond. That's something novel. I mean, blockchains have not implemented this at scale, but we think it's a really important feature.
Thank you. Matteo is asking a very straightforward question. Given that DM is not a charity, how is it going to monetize?
Yeah, it's a super important question also because, you can imagine our promise of fading out our coin being an empty promise if it wasn't backed also by the business model. Economists like to kind of prove things with their wallet, not with cheap talk. The DM business model, it's one that is based on very small transaction fees for payments on chain. That requires, of course, scale, but it's a very sustainable one because in the end, DM is a transactional network, and like any transactional network, it needs to make money where it adds value. It would add value by connecting payments between different entities, and we think that single-digit basis point transaction fees at scale could be very sustainable given the overall cost structure of the project. Now, if that's not enough, over time you can also imagine added value services that take advantage of programmability, where DM could charge slightly higher fees for conditional payments or escrow, all sort of higher level programmable applications that maybe our banking partners or financial sector participants will want to use to deliver their own products and services to consumers and businesses.
Okay, Steven is asking, it's always better to have it all, but if you had to choose between establishing your new payment system or your stablecoin, which one would you drop? I think you kind of mentioned that. And are you aspiring to replace SWIFT, Visa, MasterCard?
So on the choice which one to drop, I think we've already kind of implicitly answered it, right? So we don't think the coin is essential. Where DM can add value is on the payment rails, and it is designed to be a payment system and eventually a financial application platform. The reason why the coin is really important in this space is that there is no coin that we could rely on that, for example, is backed by high quality liquid assets, one for one, with all the the parameters you'd want at scale. Now, of course, if a CBDC becomes available, that answers the question of what's the right coin to use. But in the meantime, the reason why we spend so much time in the design of the reserve, going through the motions of the Basel III framework and alike, is because we wanted to deliver something that in the hands of consumers is going to be safe and really reliable. In terms of competition, I think it's a really interesting space because to some extent, people love to write headlines about how DM is competing with traditional financial players, banks, or legacy card networks. But when you take a step back, actually, DM is an opportunity for all of the above, right? It's efficient rails. It can enable programmability. It could enable cross-border applications. And so there's something for any one of those players. And in fact, part of the recent journey has been working with entities such as global custodians and other banks. You've seen the public announcement of the collaboration, for example, with Silvergate regarding the issuance of the DM dollar. All of these institutions actually realize that this is just better technology for delivering the services and products that they're delivering today. So if DM succeeds, the pie will enlarge and will be much. We'll have all sort of new opportunities, even for institutions that you think would suffer from lower cost, more efficient, lower friction payments.
Okay, I think we only have got time for one last question, which has to be related to financial stability. And what do you say to those concerns that a successful diem could destabilize the financial sector?
I think the short answer is that if you look at the way we're integrating with banks, we're really trying to build on the existing system. So this is not a network that will affect how money is created and how central banks would do monetary policy. Of course, you have crypto assets out there that are a much different type of challenge, I think, to central banks. Again, we're a player that wants to work with central banks and really identify how do we bring the benefits of these interoperable, new programmable networks to traditional payments. That's kind of our mission, and I think we're being very transparent about how we're really open to iterating the design further if needed to get this to life.
Okay, Christian, thank you so much for your presence and for your insights, and most of all for the answers you've given today. I can tell you that there is at least another 20 to 30 questions we had unanswered, which is testimony to how interesting the topic is. And so thank you very much again for your availability. The best of luck to your future efforts. This is concluding our first Mediobanca RegEvents. I hope you enjoyed it as much as I have. And please look out for invites for future RegEvents. Thank you very much.
Thank you. It's been a real pleasure. And I think it really speaks to all the background work that you have done, Andrea, on this in terms of thoughtful questions and really setting the stage for a fruitful conversation. It was my pleasure to be here.
Thank you. Speak soon. Bye-bye.